So in this class, we will first discuss concepts of working capital. Now working capital, the meaning, the nature of working capital, we have already seen, like what working capital means, why do we require that working capital in the business, alright, how do we bring it, for what different reasons we need that working capital. Things like salaries, inventory, all of this is paid out of the working capital. Now, when you calculate working capital or how much working capital you have in the business, all right, what you need to look at is your balance sheet. Whenever we look at working capital or try to figure out what is working capital, we look at a balance sheet. And in the balance sheet, we have, of course, your fixed assets. Alright, this is the basic standard format of the balance sheet. Fixed assets, marketable securities, then you will have something called current assets. Same way in the liability side, you will have share capital, and of course you will have other liabilities, right? You will have long-term liabilities, and then you will have something called current liabilities. Okay, now if we explain the same thing in a more detailed format, that same balance sheet will have certain items like for example, under current assets we will have things like stock, am I right? Then there will be debtors or receivables as we call them, okay? Any short-term advances or loans that have been given by the business to somebody else, right? You will have prepaid expenses, prepaid electricity bills, wages, rent, salaries, anything that is prepaid or given in advance will come under your current assets. And of course, we have cash in hand and at bank, both types of cash, right? So all these form part of our current assets. Same way under current liabilities, what will we have? Small things that other people owe us, are supposed to pay us, like creditors, right? Or that we are supposed to pay to other parties, correct? So whatever we owe in the form of any money that is payable to creditors, maybe we purchase some goods from them. So whatever we owe them in that sense, then say for example, then say we have any outstanding wages, alright, wages, salaries, any other outstanding expenses, things or expenses that we have not paid to any of our creditors, people who are supposed to, people who have provided us services, people who have provided us any type of goods and we have not yet paid them. Then say you have provisions for taxation, proposed dividend, all of these come under our current liabilities, okay. Now, when we calculate working capital or when we decide how much working capital we have, we do it either by looking at all our current assets, or there is another way of minusing the current liabilities from the current assets. I'm sure many of you have calculated the current ratio, right? We have something called the current ratio, or we also call it the liquidity ratio. It is a type of a liquidity ratio. Then there is also something called quick ratio. Fine. So these ratios are nothing but they try to see the working capital levels as to how much liquidity the business has. So one way of calculating or looking at working capital is by looking at only current assets, right? And this method or this concept is called the gross working capital. That means you're taking only current assets, the total of current assets. So it's a gross working capital. You take all the debtors, receivables, marketable investments, any cash, inventory, everything that you have, short-term advances, all these is taken and considered as your working capital. So you say, okay, this is my working capital requirement because I need all these current assets. Another way of looking at it is by taking current assets, alright, and minusing current liabilities. So take all of your, you try to make a difference. You take all the current assets and minus how much current liabilities you have. That means you get the net working capital out of these. Alright. Now the net working capital can be either positive or it can be a negative figure, depending upon which one is higher. If your current assets are more, you will have a positive net working capital. If your current liabilities are more, that means you are supposed to pay others more than what current assets you have, then in that case your net working capital is going to be negative. Alright. So these are just two ways or methods in which we look at working capital and we compute working capital. Alright. And it shows you, both the methods show you what is the liquidity position of your business. That is, at any point of time will you be able to pay off the debt, the current liabilities that you have in the business. Alright. Now, those were concepts. We also have something called types of working capital. Two simple distinctions that we have, two simple types that we have. First one being permanent working capital. It might sound a little strange to call working capital permanent, because we know anything that remains for any capital that remains for a long term in our business, we call it fixed capital. So what is permanent working capital and what is temporary working capital? Now see, there are certain expenses or working capital requirements in the business which are always there. They are there on a continuous basis and they are there on an uninterrupted basis. Like you always need money for salaries. Am I correct? Salaries is something that it doesn't fluctuate much. You know that, okay, these are my salaries that are payable to the employees for this particular year, and you know that working capital requirement is a fixed requirement, and you will need that much amount in the form of salaries. Same way your rent or your electricity, these are type of expenses that occur every single month and they are just there on a very continuous basis. Alright, so that is called permanent working capital. The working capital requirement which is required, which is needed on a regular basis, on a constant basis. Okay, so regular or constant requirement of working capital is called permanent working capital. Fine. Now, there are certain times when you suddenly need more working capital. For example, let's say your sales have increased. Okay, there is sudden demand for one particular product, right? And you have to increase production now because there is more demand for your product. You need to quickly, immediately increase production. Fine. So what happens in that case? The moment you need to increase production, you also need to increase your raw material. And more the need for raw material, that means more the need for working capital. Okay. Now even for raw material, the need for raw material is constant. We know that we require raw material throughout the year for our production. But there may be some seasons during the year, there may be some months during the year when the production is suddenly very high and the raw material requirement suddenly goes up, right? So in that case, we are going to need a little extra working capital. So that working capital which is needed over and above your regular requirement or that additional working capital that you suddenly need is known as temporary working capital. The permanent working capital is the regular constant requirement. Like for example, if we sit and calculate, we will know that okay, our business requires 1 lakh rupees in a month for salaries. Then it requires at least, on an average about another 10 lakhs for raw materials. Then it requires something else for electricity. So those common expenses That common requirement, we have it in our mind, we know how much we need it, but then some days it so happens that you suddenly require an additional level of working capital because of seasonal changes, because of any emergencies, it can be because of any sort of calamities also. Suddenly something goes wrong and you lose raw material, or your raw material gets damaged maybe in a fire or gets stolen, and you need to bring in more raw material. So because of these uncertain circumstances or these unusual sudden circumstances, you might need some additional working capital. Alright. So anything that is needed to meet fluctuations in the demand because of seasonal changes or so, that is known as temporary working capital. And this temporary working capital also increases over time. If you are a growing business, if you are a business that is doing well, then it keeps on improving or it keeps on increasing over time. So that was the difference. The concepts of working capital are classified as the gross and the net working capital, whereas types are the permanent working capital and the temporary working capital. Okay.